Hey everyone, welcome to Jobs Data. Let me make sure the volume's up here. Let me know if volume's okay. Obviously, we're mobile here. Okay, expectations are that we are going to get a change in non-farm payrolls of 265,000. Last month, we were at 390,000. Unemployment rate is expected to stay flat at 3.6. Big number that we're looking for is the average hourly earnings number. Is it going to move more than 0.3%? 0.3% is an annualized inflation rate for wages of 3.6%, which is actually the same as the potential unemployment rate. We will see. Obviously, hearts go out to Shinzo Abe, who has been assassinated yesterday, and we don't yet know why. Let's get our jobs data now. Okay, unemployment rate 3.6. We matched. Change in non-farm payroll. It did better. Wow, it did better than expected, and the average month-over-month hourly earnings went up by the expectation of 0.3%. We got 372,000 jobs. The force participation rate actually fell to 62.2 from 62.4. But this is actually a beat for this month. We did get a revision for last month of a subtraction of 74,000 jobs. But this month, we're actually beating by about 70,000. So you kind of see roughly that same shift there. But change in non-farm payrolls comes in at a beat, 372,000. You have the unemployment rate staying at 3.6%. And again, those average hourly earnings coming in at 0.3%. The prior, hold on a sec here. Actually, okay, prior unemployment was not reduced by 74,000. It was only reduced by 6,000. Sorry, I read that wrong. And the average hourly earnings for last month did tick up 0.1%. So they're revising last month from 0.3% to 0.4%, and they're keeping this month at 0.3%, which is the expectation. Okay, this is somewhat decent. It should be decent at least. I mean, we'll see how the stock market is reacting. But what we don't want to see is any kind of sign of a wage price spiral. We'll go ahead and look at the documents in just a moment, but we really don't. We really want to avoid anything that suggests, oh, wage price spiral, right? The Nasdaq's down presently about 0.8%, so 0.8%. Let's go ahead and look at the actual jobs data here, and we'll go ahead and pull this up. So here's the actual jobs report. Let me go ahead and throw it into a PDF. Give me 1 second. This is the perfect opportunity, of course, to mention that this video is brought to you by Tasty Trades. Go to metkevin.com/tasty and get $200 in totally free stock when you deposit $2,000 with them. That's 10% of a return right away. So go check that out by going to metkevin.com/tasty. All right, we've got the BLS report up. So we've already got the numbers in that we're matched on the 0.3% for month-over-month expectations. We did get a 0.1% tick up for last month in the wage gains, and we actually beat in that change in non-farm payrolls. 372,000 compared to the expectation of 265,000. Now, I just want to speak to that for a moment, because 372,000 jobs, when we're expecting, the Federal Reserve's job to actually start taking effect, it might be another sign, though, that the Federal Reserve still isn't tightening enough, that maybe they have to do more. So even though we're not really seeing that wage price spiral, we're still seeing a pretty hot jobs market, and that could end up convincing the Federal Reserve to be a little bit more aggressive. So this is going to be something to pay attention to right here. Again, unemployment rate remaining at 3.6. That's fine. Let's see which categories are really blowing up. This labor force participation rate declining a little bit below expectation. It's unfortunate. But the actual sectors that gained and lost would be very interesting to see. So here we go. Employment in professional and business services grew by 74,000, with management of company enterprises growing 12,000, computer systems and design 10,000, admin services 8, R&D 6, And I do see a lot of R&D spending, by the way. I was looking at Meta, and in our course member live stream a couple days ago, we did a review of some of the initial fundamentals of Meta, and we were blown away with the amount of money that they spend on research and development. I mean, Meta really is almost a complete research play into the metaverse and like VR and AI. I thought that was very, very interesting. Keep in mind, almost every day, it's harder when I travel, but generally every day when we do a course member live stream, we do a fundamental analysis on something. And you get lifetime access to those course member live streams with me in the link below. So, leisure and hospitality here, we had 67,000 jobs. However, employment in leisure and hospitality is down by 1.3 million since Feb of 2024. What's interesting about this is it really speaks to this idea that we haven't yet figured out how to get to an equilibrium, because we're seeing in many cases travel and air travel, hotels actually. We see more people using these things, but we actually have less individuals working there. So this is an interesting note by the BLS, and I think that's why you see so many flight cancellations. Employment in healthcare rose by 57,000. Transportation and warehousing added 36,000 jobs. Manufacturing increased by 29,000. I mean, this is across the board gains here. I mean, mining, oil, gas, everything grew. I do not, there was no category that dropped. Wow. There was no category that dropped. Social assistance rose, information added 25K, wholesale trade added 16K, 8K in non-durables, wholesale, okay, well, that's just relative to before. No declines. I mean, the fact that we're not seeing any kind of declines really suggests that we're still in a kind of a booming economy here. Now, I do want to see what the 10-year break even is doing right now, yeah, or even the 5-year break even, because that's how we can track our inflation expectations. As we saw yesterday in the video that I did with the Blackboard, it's really important to watch the break evens. Break even yield spiking a little bit, but not much. We're still at 2.6%, still substantially lower than. Let me go ahead and share the screenshot here. Still substantially lower than where we have been since the beginning of the year. Give me 1 sec for the screenshot. All right. Stand by, iPad. Here you go. So you can see the break evens here, and you can see we've got a little bit of a spike here just in the last couple days on the 5-year break even, but still the inflation trajectory. I mean, this never is flat, right? I mean, throughout the course of these break even charts, you see this sort of rigidness. So not a surprise that we're seeing a massive move to the downside there. Okay, anything else in the labor report that we really have to look at? Let's go back to the labor report. The let's see here. Average work week for all employees held at 34.5. In manufacturing, the hours were a little changed, and overtime fell by zero point 0.1 hours. The average work week in production and non-supervisory remained at 34 hours. The change in total non-farm payroll was revised down. No, here, this is what I thought. It was closer to 70,000. What was this? The change in total non-farm payroll for April was revised down by almost 70,000, 68,000, from 436,000 to 368,000. And May was revised down by 6,000. With these revisions, the April and May employment is actually 74,000 lower than previously reported. That's what I saw. Okay, that's what I thought. Okay, that's very interesting. So even though, and I think this is a good conclusion to sort of make, even though today's report came in about 70K jobs hot, April and May were technically 70K jobs light. That somewhat means we came in at expectations, not hot today. Now, that might take a little bit more nuance for the stock market to understand. So I don't know if we're going to really see stocks understand that very well today. But we'll see. I think this is very interesting. Let me see how stocks are moving right now. I do not have it set up on. Sorry, excuse me. Okay, so it looks like, we've got some. We have a decline in, for example, Tesla. Tesla dropped about 0.4% after the jobs report. QQQ, the Nasdaq, right after the jobs report dropped about 0.5%. We were actually green and we went negative. Now we're actually sitting down 0.8 tenths of a percent. We were positive before the jobs report. But I really think it's going to take a minute for the market to kind of parse this data. And I think once the market realizes, wait a minute, but we had revisions down of 70,000. So sure, we came in hot today at over 70,000. And sure, that might, suggest a more aggressive Fed here. But you have to consider the fact that we just had a reduction of 74,000 jobs in the prior. Okay, let's see if there's anything else. I think that's really important nuance to have. Okay, no, these are just tables here. No job losses though in any category. I did think that was very interesting. 7.1% of people teleworked because of COVID. Oh, okay. And okay, let's see. Okay, yeah. So let me go ahead and take a look and see what the suits are saying. But I expect the suits are going to say something somewhat similar. I'll give you a report of this. Okay, so yeah, for those of you just now joining, it looks like the indices are dropping, and we've seen a decline of about 0.8% on some of the indices from positive. We were actually slightly positive, and we've seen this because the labor report came in a little bit hot. We had the same expectations for month over month wage gains, and this is good, right? That's that annualized 3.6%. But unfortunately, we came in a little bit hot with the labor report. We were expecting 265. We came in with a figure of 272,000. Now, what's interesting about this, though, is we did get a minus revision of 74,000 jobs over the prior 2 months. So even though we beat here, we beat by a little bit over 100,000. We did lose 74,000 jobs. So it almost feels like these are a little bit of a wash. Because I don't know if the market would really move off of like a 30,000 beat. I mean, that'd be pretty dang close. Okay, markets have priced in a total of 180 basis points for the remaining Fed meetings of the year. This means the Federal Reserve's funds rate is expected to double by December to 3.5%. That's correct. We have seen exactly that. Remember, we did still see that the JOLTS indicator came in at 11.2 million jobs. That's hot, right? And that's another issue. We were actually expecting that JOLTS measure of job openings to come in potentially at 11 million, maybe even below 11 million, showing that companies are tightening their ship, showing that companies are spending less money. But that's not what we saw. And now, yeah, okay, well, this report is also now telling us that there are only 5.9 million people actually looking for a job right now. That is according to today's labor report. Wait a second, that's actually a little bit of a problem. Oh, yeah, okay, so this could be another reason we're having issues. All right, so take a look at this. JOLTS job openings came in at 11.2. We thought that would mean the ratio of those looking for work would drop from 1.9 to a lower level. What this means is, and I'm writing this down just to sort of give you some conclusions here. We thought the JOLTS openings would go from about 12 million to 11 point, and they ended up going to 11.2. We thought they would go to 11. And we thought that would mean that the ratio of people looking for work to open jobs would drop from like 1.9 to maybe 1.8 to 1.7, and we'd start seeing that compression. Because remember, Jerome Powell says he wants to see that get to equilibrium. Equilibrium is 1. That means you have one job opening per person looking. Well, according to this latest jobs report, in this BLS report, there are 5.9 million job seekers in June. That number actually came in lower than expected. So that could be another reason we're seeing some red now. It looks like the options market is also showing a greater likelihood of a 75 basis point hike in July here. That could be why we're seeing markets turn red on this report. And it doesn't look like it's getting better. The NASDAQ is now down a complete 1%. So it actually looks like as the market is digesting this news more, we are going down more. The S&P 500 is down 0.6%. The decline of the participation rate suggests that the demand or that the strategy to cool the labor market has relied on curbing job demand, but that's not a friendly message for risky markets. Let's parse that. The decline in the labor force participation rate of 0.2%. Okay, got it. It's basically saying that in order to cool the labor market, the suits are believing or interpreting that the Fed is basically going to be stuck with trying to do everything they can to get that JOLTS number down, this 11.2 number here, and we're actually not getting that number down. And so job demand has to cool, and we're not actually seeing a cooling of that yet. Now, it's important to remember a lot of these numbers are lagging, right? Like this report is from June, and it was probably surveyed between the middle of June and the third week of June, right when the Fed raised rates. So it's like the market doesn't even have time to react to these things. Well, the market does, but not the actual like job market. So this is now being called a green light for another 75 basis point hike. That this strong jobs report, despite the 74,000 job loss over the last couple months, despite that, this strong jobs report basically puts the nail in the coffin for a 75 basis point hike. Okay, that explains why we are seeing the S&P down now 0.7%. Let's see how the 10-year Treasury is doing on this news. 10-year Treasury is actually slightly up, it looks like. 3.03 is the last read I have here. And yeah, actually, I'm sorry. Oh, that's interesting. I have 3.03 here, but CNBC is actually reporting this with no delay at 3.08. So I could be seeing a little bit of a delay there. Let me see if there's just a present move within the chart here. No, there's no specific move at the jobs data for the CNBC representation of the 10-year, but we are seeing the 10-year at 3.08. That is over 3% again. Anything over 3% does really strain real estate. And I think that's a big opportunity that we want to pay attention to going forward is real estate and the real estate market, as desirable as I think it is, to also take advantage of buying the Redfin data center or in the stock market. Redfin data center is certainly starting to show us that inflection point in real estate for at least what we're seeing in price drops. This is nationwide an increase of price drops. But if you go to specific regions, which is so incredible, you go to like, let's say in Austin, you really start seeing, or even Boise, you really start seeing how the percentage of active listings with price drops has actually substantially increased, even more so than the national average. Very interesting. Okay, that is our jobs report. We have one more note here. Employment population ratio moves down. Yeah, exactly. Moving in the wrong direction. This is a tough one for the White House because they will want to showcase good continuing job gains, and continuing wage gains is a good thing. But the flip side is without some slowdown, it adds inflationary pressures. Yes, it does. And again, we were expecting 0.3% on wage gains. We did get that. Still no evidence of a wage price spiral. If we start seeing evidence of a wage price spiral, nobody's going to save us. We will just be straight up screwed. But the good news is you can still get life insurance in as little as 5 minutes by going to metkevin.com/life. And you can get yourself up to $200 in free stocks by going to metkevin.com/tasty. That's metkevin.com/tasty to get $200 for free when you fund $2,000 at Tasty Trades and Tasty Works. All right, folks, thanks for being here. See you soon.